Unit 3 talks specifically about market structures and the type of industry and structure each market experiences. What is the role of government in a market economy? That's the question we'll seek to answer in Econ 3.5. What do you think? Do you strongly agree, somewhat disagree, or strongly disagree with each of the following statements? The government should increase taxes to expand programs for the elderly. Do you strongly agree, somewhat disagree, or strongly disagree with that statement? Take a minute to jot that down in your notes as we'll discuss it in class. The government should ease up on regulations protecting the environment, which means that you would support more free use of the environment by businesses, individuals, etc. The government should break up existing monopolies, so businesses that you feel that have partaken in monopolistic behavior, such as Apple, Microsoft, etc. So what do you think? Based on where you stand on those spectrums, answering that question is how much you think the government should or should not be involved in a market economy. There's disagreement in every household across the country, Republican, Democrat, Independent, Libertarian, etc. There's a lot of discussion about this. But we're going to look at the traditional roles that the government has played in a market economy, and we will later in government talk about whether you agree or disagree with these policies. Okay? The main role of government in a market economy is to correct for market failures, whether that market failure is income inequality, certain other side effects, such as externalities, collusion, or the formation of a cartel by an oligopolistic industry, or not protecting workers' rights. So the main role of government in a market economy is to correct those market failures. One of the most important roles of government in a market economy is to protect the property rights of the people. Whether the people are individuals and households or businesses, the government tries to do this, encourages people to take care of their property. By enforcing their property rights, by protecting people on their property with certain laws, law enforcement, etc., it encourages people to take care of their property, make the most productive use of their property, which means that if they're a business, to use it for the most allocatively efficient process possible, and to develop their property in ways that benefit others, such as taking a farm field and redeveloping it into a housing complex for low-income families would be a way to develop their property in a way that benefits others. In addition, the government seeks to maintain competition. The government does this through a series of legislation. Some of that legislation has been for antitrust legislation, which you may remember from U.S. History 10, the trust busters and the breaking up of the big monopolies like the railroads and the steel industry back at the turn of the century. But maintaining competition today means monitoring mergers. So the merger that brought Verizon and Sprint together, is that who merged? Doesn't matter. When mergers occur, the government monitors those mergers. They regulate monopolies. Remember, sometimes we talked about legal monopolies, such as those monopolies that are natural or geographic or technological. The government seeks to maintain those monopolies. They regulate oligopolistic industries, like the cereal industry. They prohibit price fixing, that collusion, that cartel making, and market division. The government mainly does this through the Federal Trade Commission. The Federal Trade Commission is about 100 years old. It was created in 1914. And it was created to investigate charges of unfair methods of competition and commerce. If the FTC discovers such practices, it can order a company to change its method of doing business, or it can face severe fines from the United States government. So maintaining competition is a very important role for the U.S. government in a market economy. Furthermore, the U.S. government seeks to protect consumers, savers, and investors. Specifically for consumers, those people who are buyers, they are protected by a variety of agencies. One of those agencies is the Food and Drug Administration. They make sure that every food label and every drug label is adequately informs each citizen what they're putting in their bodies. In addition, the National Highway Transportation Safety Administration, that group seeks to provide standard road signs, standard lighting, standard speed limits, etc., to make sure that every citizen in the United States is as safe as possible when traveling at high speeds on the highway. And another one of those agencies, this is certainly not an all-inclusive list, is the Consumer Product Safety Commission, which protects people from products like some unsafe foods imported, unsafe medicines, toys, clothing, etc. In addition, the government protects savers and investors through the Federal Deposit Insurance Corporation, which protects your bank deposit. As you probably remember from U.S. History 10, prior to the Great Depression, there was no insurance on bank deposits, so when banks went under, the money just disappeared. The government has remedied that. In addition, the Securities and Exchange Commission regulates the stock market to make sure that people are trading fairly and without insider information. So the government seeks to protect consumers, savers, and investors. They haven't done the greatest job in the most recent years, so some people feel that these agencies need a little bit of revamping, and perhaps that is the case. Protecting workers. It is the job of the United States government and local governments to protect workers from all sorts of things, falls, hazardous waste, etc., whatever is a hazard at their job, whether it's physical, mental, emotional, etc. So protecting workers is the job of the United States Department of Labor, and they protect workers' economic rights. So this is things like minimum wage, your right to form a union, etc. And then for the physical and mental stuff, the Occupational Safety and Health Administration protects workers' physical well-being. Okay, it protects you from falling, slipping, all those things where at your job you probably have to watch those videos about workplace safety. That's OSHA, the Occupational Safety and Health Administration. So in essence, what the government does is they provide a lot of agencies which protect or correct for different market failures. And one of those market failures that they try to correct for is externalities. Remember, an externality is a side effect of production or consumption, so a side effect of buying or selling that has consequences for people, a third party, other than the producer or the consumer. Okay? The government seeks to limit negative externalities by charging things like taxes. So back in the aluminum factory example, they charged those taxes for the aluminum factory to try to prevent too much aluminum being produced, or aluminum in addition that would be more costly to society would not be produced. In addition, the government supports positive externalities. Those positive externalities like flu shots, they subsidize a lot of things like flu shots, education, etc., in order to provide more of them because the market in itself doesn't provide enough of them. For example, here in Byron, most kindergarten through 4th grade children receive a free flu shot, and the school district provides that support. They support the positive externality because there are social benefits outside those kids who receive the flu shots. For example, if those children don't stay home sick, then their parents can be more productive at work. They don't have to stay home from work either. So the government seeks to protect both positive and negative externalities to make sure that the markets are being as efficient as possible. Okay? The government also seeks to provide public goods. The government provides all sorts of public goods, whether it's police, fire, parks, national park system, stoplights, etc. And they provide those public goods because most public goods and services are produced in our economy. Most goods and services produced in market economies are private, like the Apple iPhone, your shoes, your jeans. They're produced by private businesses, and only the consumers who purchase these goods can consume these goods, whether it's hamburgers, shoes, whatever. But there is a lot of need for what we call public goods. Remember, public goods, talked about in the last video, are used collectively and no one can be excluded from using them. You can't exclude somebody from benefiting from national defense system. You can't exclude somebody from using a public park unless, of course, they create some kind of crime in that park. But the government provides a lot of these public goods. And remember, public goods have two characteristics. We went through this before, so this should be review. Public goods, these are what we call non-excludable. Once a public good is produced, it's difficult or impossible to exclude others from consuming the good, even if they didn't pay for it. For example, I benefit from national defense when I was a kid, even though I didn't directly pay for it in the form of taxes. Furthermore, Public goods are what we call non-rival in consumption. When one person consumes a public good, like enjoys a public park, it doesn't prevent others from consuming the good also, because they could enjoy it the same day, later that day, in the future, etc. Okay? Whereas that's very different from private goods. So the government provides these things to people in order to make sure that the public has as much as they possibly can in a market economy. But there is this issue of public goods of what we call the free rider or freeloader problem. There's no way to make people who benefit from the public goods pay for them. So the government usually has to shell out a lot of money and doesn't get a lot in return. In addition, there are people who don't pay for them. For example, illegal immigrants benefiting from a healthcare system in which they don't pay for. The free rider or freeloader program is typically associated with people who just kind of sit around, don't do anything, and get the benefits off of everyone else. Since private businesses do not have incentives to produce enough public goods, the government struggles with this free rider program where there's people benefiting but don't necessarily pay for it. A lot of people associate this with just the lazy bum on the couch. There have been various movies about it. The free rider problem certainly exists within the government. Okay. Furthermore, the government seeks to provide or promote economic stability. They do this by fighting unemployment, providing job assistance, welfare assistance programs, etc. Furthermore, they encourage price stability, so reducing inflation. We'll talk about that more in the next unit, to try to keep prices as stable as possible. That way you know when you go to the grocery store generally what you'll be able to afford. If your cereal fluctuated between $7 a box and $2 a box, it would be pretty difficult to plan or budget for a family. In addition, they try to promote economic growth. This is providing incentives to small businesses, tax breaks to large corporations, etc. Okay? And this is all done through the United States government, typically the federal government, and not at state or local levels, but sometimes it can take place at state or local levels. The final role, although not necessarily in order of importance, is to correct for inequality. That means redistribute income. Okay? This provides an economic safety net for some people, whether they're disabled, elderly, etc. The government promotes economic well-being, which means it provides government programs that are designed to reduce the gap between the rich and the poor. The government tries to accomplish this through a system of what we call transfer payments. In a transfer payment, the government takes money from one group of citizens and distributes it or transfers it to another group of citizens. So this would be you paying into Social Security now and your grandparents benefiting from that Social Security. It taxes those with larger incomes to help those in need. We have a graduated tax system in this country, which we'll talk more about in government as well. Again, the U.S. government does this, and some people are very upset that the U.S. government redistributes income at all. But if you look at annual household income, and again, this graph is 6 years old, you can see that the top fifth of people, so the top 20% of all Americans, that means there's 20% that make approximately $100,000 or more, okay, households, have approximately half of the wealth in this country. Now, since 2007, this slice of the pie has gotten even bigger. So the wealthiest 20% in our country have a large portion of the income, and therefore the government takes a larger tax from them and redistributes it to help those in need, whether they're elderly, disabled, or poor for any other reason. So these are things that the government does to protect against market failures in a market economy.